Why have mortgage rates not come down yet? That's what we're going to cover in this monthly market report. This is for you if you are a real estate agent, a financial advisor, or an attorney interested in market data to help you advise a client, or perhaps you are that potential buyer or seller looking for some direction. I'm Paulo Rodriguez. I've been a mortgage professional since 2005, and here is the market data that you need to make an informed buying or selling decision or help your client do the same. The election is behind us and we have a new administration. So what does that mean for the real estate market? I will make no political statements to answer the question. Whether or not you like President Trump is not my concern, and whether or not I like him should not be your concern. It's relevant. I'm simply going to lay out the facts and explain what the market's reaction has been thus far. Firstly, we have to understand the effect of Trump's victory on US yields. Yield is simply the return you receive on your investment if you buy, for example, US Treasuries. US Treasuries happen to be one of the safest investments you can make because they are backed by the full faith of the US government, and thus the chances that you don't get your money back or don't get your interest paid to you are very small. If you buy a US Treasury, the US government pledges to pay you a return in the form of interest. It won't be like winning the lottery, but you will make a very dependable stream of fixed income. Money that is looking for an investment has to make the choice between the safety of instruments like US Treasuries and bonds, or something with a bigger payoff and therefore bigger risk, such as equities, which is the stock market. Post-election, at the time I'm recording this in mid-November, the stock market has rallied as it repositions itself for a Trump administration. And the reason for that is because the market is anticipating that Trump's economic plan and his America First foreign policy will lead to substantial economic growth. Since the election, a lot of capital has flown into the US as a result. This is a combination of foreign capital seeking investment as well as American companies repatriating their foreign earnings back on shore, either because they want to reinvest the capital here domestically or because they know Trump is going to drop the hammer on foreign corporate earnings like he did in 2016. Now, remember a moment ago, I said that money-seeking investment has to choose between safety with a low return, like US Treasuries, or more risk but with a high return, like stocks. Well, it has been choosing the bigger payoff, stocks, because of Trump's victory, at least at the time of this recording. Therefore, to attract more buyers, the return on investment on US Treasuries, the yield has to rise. And that is why mortgage rates have been going up, because yields in general have been going up. Economic growth, by and large, creates inflation, which, as you know, erodes the value of money over time. So if anyone is going to buy a US Treasury or similar investment and subject their money to the potential erosion of value over time, they need to be paid a higher interest rate to compensate for their risk. That is why yields rise, and that is why mortgage rates have been rising instead of dropping. Also contributing to the prospect of economic growth is the market's anticipation that Trump will bring stability to the Middle East and that he will make a deal with Putin to wind down the situation in Ukraine. Economic growth is more likely in the absence of uncertainty. Wars bring uncertainty because they may affect the supply and therefore price of oil, or also because if you have two superpowers pointing nuclear weapons at each other, that makes money want to stay in safety instead of seeking higher risk investments that lead to innovation and therefore economic growth. The de-escalation of these conflicts will be a positive for the economy. So that now begs the question, if the market believes the economy is going to be so rosy going forward, does that mean we won't see lower interest rates? My answer to that, at least today, is that we will see lower rates, but it will take more time. What would make me change my mind? Inflation turning around and going the other way. If inflation starts going up again, then the outlook will be completely different. So there you have a high-level view of the mechanics that are driving our interest rate environment. And of course, that affects the real estate market as a whole. Again, this is not a political discussion. It's strictly economics, and it's simply my job to read the market's reaction to what is happening and help you skate towards where the puck is going. So with that in mind, does that mean that prices are going to go up or are they going to go down? What will it take for prices to come down? This is the age-old question, and it's true that what goes up must come down. And there are many people in real estate right now that feel that way. They feel like, you know what, I've seen this market going in this direction and I don't see it sustaining itself. Well, I've said this many times before since prices rose in the pandemic, and I'll say it again. Just because something has gone up in value is not a reason in itself for that value to come down. We have to understand what is going on with demand relative to supply before we can make that judgment. So let's see visually why prices have gone up the way they have. This happens to be one of my favorite slides, and the data is from the US Census. This is a look at new construction nationwide going all the way back to the 70s. What you can see is that literally in the 70s, 80s, and early 90s, we built more homes in this country than we have in the last 15 years. The red bars represent the last 15 years of single-family housing units built. And as you can see, builders aren't overbuilding right now. They're just trying to catch up from all the underbuilding years after the housing crisis. What's astonishing is that in the 70s and 80s, we had a population a little bit over 200 million, and we built more homes in those decades than we have in the last decade, with an ever-growing population that currently sits at an estimated 340 million. That's fewer homes built in the last decade for a population that is more than 50% larger to what we had in the 70s and 80s. Can you see why demand and supply matters, and the fact that something has gone up in value is not a reason in itself for the value to come back down? The fact that we had the lowest rates in history coming out of the pandemic, that was just gasoline on the fire. The issue was already brewing. Now, I'm not suggesting housing values are going to go up and up and up. I'm just saying there's not enough evidence to suggest that they're going to come down in any meaningful way. Maybe there's a short dip here, another dip there, but the big picture trajectory continues to be positive. Here's a slide showing what 10 reputable forecasters are saying. Now, some of them get it wrong, some of them get it right, but the average tends to tell the story, and that means about a 2.5% increase in value for 2025. Now, you might say, hold on a minute, there are so many more listings now as compared to before. Doesn't that mean prices should come down? Yes, it's true, we have more listings. As a matter of fact, here's a quote from the senior economist at Realtor.com. There were 29.2% more homes actively for sale on a typical day in October compared to the same time in 2023, marking the 12th consecutive month of annual inventory growth and the highest count since December 2019. But what does that exactly look like in the big picture? Here is a bar chart showing new homes coming to market according to Realtor.com, going all the way back to 2017. You can see 2017, 18, and 19 were pretty normal years. And then the pandemic comes along and depletes inventory, which bottoms out somewhere in the beginning of 2022. And then we've been in this upward sort of trajectory ever since. The most important takeaway here is that inventory levels are still below what they were in the most recent normal years. So we welcome more inventory because we need it. But you need to zoom out and recognize that rising inventory levels are not a cause for concern at present. In closing, I recognize that I have been bullish on the real estate market since the pandemic, which is pretty much as long as I've been doing these monthly reports, 4 years now. But I'm not bullish just because I'm in the real estate market and I have my blinders on. I do realize that prices one day will come down, and all the people who have been forecasting a crash will one day be right. But in business, it's not enough to be right. You have to be right at the right time. Being right at the wrong time is no different to being wrong, period. After all, a broken clock is right twice a day. That's a wrap for the December market report. I appreciate you listening in. Forward, subscribe, share. I'll be back in the new year. But before you go, if you are looking to purchase or refinance or know someone that is and would like a no-cost consultation with me personally, feel free to reach out, and I'd be happy to analyze if your debt is structured in the most optimal way or if there's room for improvement. Thanks for watching. Bye for now.